Good morning, everybody. So we made it. They rolled the put wall up last night. If you've had a chance yet to read the founder's note from Spot Gamma last night, of course, when I get the morning one, I'll post it. In the post, they said it's really bullish to roll up the put wall. So while I was going to say it, it's always better when they say it because, man, it's their tool. I don't know about you guys, but I'd rather hear them interpret their tool than hear myself interpret their tool. Data coming out of Europe this morning was a little shaky, knocked the market to the downside, offered us a nice little liquidity gap close. So a little reset. That was nice to get some kind of movement in the pre-market. It's where I do the bulk of my trading, so I take what I can get. The Russell is still down the most, hasn't recovered from that little wobble yet. The Dow right behind it, S&P, and then the NASDAQ basically flat with Japan. Europe is up the most. UK 100 is at a little under 0.75%. We've made it through most of the worst of the economic data points. We still have ISM manufacturing today. And yes, this can be enough to kind of keep a headwind against the market. But it seems like if you haven't noticed through most of the week, the data has been holding back the market through the indexes because we've been in this kind of hurry up and wait for a lot of the data. And we said it was going to be like this on Monday. So it wasn't much of a surprise. But the rest of the market, everything that wasn't the Mag 7 has really been doing good. You know, separate the earnings, of course, things that are getting severely punished or absolutely rewarded. The rally is broadening out. They're calling it the everything rally or the everything bubble, depending on, if they're perma bears or not. Seems like there's always, a doomsday crowd looking at every brick in the wall, trying to explain why the market should be crashing right now. And then we just continue to make new highs. Those kind of people are right 1 in 10 times. And oh man, they make a noise when they're finally right. So ISM services, we can see bright red bar. It's the highest volatility event of the day. It's the biggest threat other than the fact that we have a lot of Fed speakers today. It's not just the fact that we have Fed speakers. I've had people say, I don't understand, we were waiting on a Fed speaker, nothing happened. Yeah, but that's the problem. It's like going to a NASCAR race. You kind of assume there's going to be a crash, and a lot of people go just to watch the crash. And then if there's no crash, I mean, it's kind of a good thing, right? Don't want to see people getting hurt at a car race. But that's where the carnage is at. It's kind of what people want to see. And with these Fed speakers, a lot of times nothing happens. They don't deliberately try to throw Molotov cocktails into the market and shake things loose. They can. That phrase plunge protection team can work both directions. They can push the market down or lift it up, which is something I never really understood as a newer trader. In my mind, I was trying to imagine how the Fed could buy so much to make the market move up, or they could sell so much to make it move down. But they don't have to buy or sell anything. All they got to do is open their mouth. So a lot of times they're really not trying to shake the market, but foot to mouth, everybody's human. They can make mistakes. They can say the wrong thing, imply the wrong thing. And then, of course, a reporter can take whatever they say and twist it out of context and make it sound like something they didn't mean to say or make it imply something they didn't mean to imply. So there's a lot of room for human error and for things to go wrong whenever there's anybody from the Fed speaking, which is why we pay attention to when they're going to speak. So sure, yeah, a lot of times we're going to get a Fed speaker and nothing happens. Trust me when I tell you the car wrecks that they can create, you'll feel it because I've made that mistake. Even if they're a non-voting member of the Fed, they can say something that is taken out of context and move the markets. Sure, we recover pretty fast, but that doesn't mean much to your account. You know, if you happen to have been in a trade when that happened. We dodged a bullet with the government shutdown, at least for a little bit. They nudged the can down the road a tiny little bit. I heard them say kick the can. That kind of implies that they got some air and maybe that can traveled a ways, but we're looking at government shutdown in March. You know what today is, right? It's March 1st. So if they kicked the can down the road into March and we're already in March, then they didn't kick it very far. I think my 3-year-old could kick it farther than that. Grandbabies. So watch the clock today. We're going to get through ISM. You can see the list of Fed speakers here. Just be mindful of the time frames that you see on my screen. Finance Juice shows my time zone, not the market time. And if you go to Finance Juice on your computer, it's going to show your time zones. So be mindful of that. It's one of the reasons that we go to different places. I've tried to get this reset where it will show Eastern time during my streams, but it keeps resetting and it's too much of a hassle. I just leave it alone. For mine, just add an hour. But if we come back here, we can see this is set to Eastern time or market open. We got 9:45, 10 o'clock, 11 o'clock, 12, 1, and 3:30. So it's all day. There's going to be something coming at us all day. I heard a report this morning that I found interesting that those big mega market cap tech companies like Microsoft, Google, they have more workers now than they had pre-COVID, even though they've had headline layoffs. Interesting enough. So they get the headline for laying off workers. That gives them a share bump to the upside. They get the layoff high cost employees while they hire new low cost employees on the other end of the fence. Love it. The market's a little concerned. There's hedging. We can see the hedging with the market maker move. And yet they're not sitting out. We can see the bump that came in. We would have had a lowered volume. It would have shown that they were sitting out and hedging, which is what we expect, those two pieces together. But we got data out of Europe that brought in a lot of volume. And then we got that nice little move to the downside. So now we've got a normalized volume level, 123. That's a good, decent, normal overnight level, but we still have the hedging. Now, maybe they were hedging because of Europe. Maybe. We want to watch this and see if it continues to grow because this number is not set in stone. It's going to shift and adjust. Right now, it's at $19 if you want to use that number, or it's at 0.37%. Before we get to the open, you want to see if that number has continued to rise or if it's falling down. If it's falling down, then they were hedging because of Europe. We're past that point, and they'll let the hedge just dissipate. Plus, there's still going to be a lot of rolling and adjusting things. We're coming up on a triple witching, which means the current futures contracts are set to expire soon. So a lot of places don't like to wait until the last minute. They'll get their rolling done early. So that's going to start adding to more of the options volume that we see and the futures volume. But it's a false volume if they're just, continuing a position. We'll see. Just keep your eye on that as we get closer to the open. Of course, I won't be streaming all the way to the open. So one of the things that you can do to see that, no matter what platform you're on, as long as they have options, is just come into the options chain and look for the implied volatility average, which is generally on the right side. I've seen some platforms that'll have it right in the middle, which is fine. Either way, look for the average. You want to see if the front one is greater than the back one, the front being the closest expiring options and the quote back one being the next one out. Right now, it's still showing yesterday's, so we don't want to look at that one. We want to look at these two. And we can see 11.4 is greater than 8.7. So we have a market maker move. If these two continue to widen out, if the front one continues to get bigger than the back one, then we know that they're increasing their hedging. It's implied volatility average. The implied volatility that they're measuring is from within the options chain itself. They use all of the out of the money puts and all of the out of the money calls implied volatility. So if I was just to take one of these columns and swap it to implied volatility, then we could see the number that they're calculating. It's right there. You can even see the volatility smirk or smile in there. This is supposed to go from high to low, but at some point we get as low as we're going to get and it starts to climb back up again. So you can see how we go from 12, 11, 10, back to 11, and it starts to climb higher again. That's where the curve is at in your volatility smile. Well, if they go in hedging, supply and demand, they start hammering at, any of these out of the money strikes. Volatility is calculated by movement. In a stock chart, that would be candle close to candle close. But this isn't a candle chart. This isn't price from a stock or something like that. So then the thing is, well, how do they calculate implied volatility when we're looking at the price of an option? How fast the option changes and how many trades per second per minute. Those are some of the metrics that go into the implied volatility calculation within the options strike itself. And then, of course, all of this is tied together with a square root of time. Yeah, you want to get into square roots this early in the morning. And some other tools that they don't publicize. Every broker has a proprietary way of calculating this implied volatility average. And so they'll never give you all of how to calculate that. They'll give you some of it, but they won't give you all of it because it's proprietary. They don't want to share it. But that's how we know that they're hedging, so we can see it, right? It's not a guess. I'm not assuming. We made it up to the previous week's close. Yay! But we still are sitting inside the previous week's range. So we'll just come out here to the daily for the minute. This is like a micro scoop pattern. If it was a little wider, and especially if it was on a weekly, it's a really bullish pattern. It's fantastic. But this isn't a weekly, and it's not spread out enough. So it's a little tight, a little congested. But you can see all this selling. Kind of got it marked out in between those two levels. There's a wall of sellers sitting up there, right about 5,100. We need to get through that level. That's our problem, right? Every time we get up into this zone, we get sold into. Now, at some point, we're going to absorb all of that liquidity and there won't be any more there and we'll be able to work through it. Or those sellers will move up to another area and we'll find them higher up. We generally call that a call wall, and we start looking for that call wall. Right now, it's at 52.11. Remember where it was most of the week? 51.11. The cog line, 51.11. So it's not there anymore. It's now at 52. They rolled the puts up. That's bullish. They rolled the calls up. Yeah, that's bullish too. So that's a bullish bias and a bullish behavior. It's easy to have a bias, but when we can take that bias and add it to a behavior, then it's even more bullish. The Mag 7 has had a chance to rest too, and that's going to help as well with a move to the upside. So we got the 3-week, the 10-day, that's right underneath us. The weekly pivot point, the volatility trigger, our own daily pivot point, the previous week's close. We got all of these levels underneath us to help stop the market from falling down. In Spot Gamma, they talked about multiple support levels through the options levels. Like, I think the word they used was two-ply, which I thought was kind of cute. A little construction talk for the DIYer. But we have the put wall now above the 0 gamma. I don't have enough history on that to be able to say how bullish it is. I was going to read more on Spot Gamma, see if I can find references to when everything else is above that 0 gamma level. But I don't want to speak out of turn. So maybe next week, someone remind me and I'll tell you what I found. So you know what I'm going to be doing this weekend. I'm going to get answers to that question. Otherwise, the range that we had through most of the week, we still have it. And before I scrunch that up, let's just go back to the daily here for a minute. It's a wide range, but it is a range. Make no mistake about it. This is last week's really big candle from the 22nd. And while we've dipped outside of that range, we're still there. We've been there all week. And it's not a nice, tight IX10 style, really compressed, impressively tight range. It's a range nonetheless. And really 50 points is pretty tight, all things considered. Call it 50-60 to 51-10. It's a nice 50-point range. And that's what we've been doing. Now, the cool thing about the market is it's a lot like nature. It doesn't like to be compressed. If you compress things in nature, it tends to explode. For our case, exploding would be moving out of this zone with force and conviction behind it. We can't really assume that we know what direction it's going to go, but if we continue this move just using some OCR, then we had a pullback and a continuation of the trend is expected. We're looking at 5,100 being the new support really soon. And we'll be looking at 5,250 as the next resistance quick enough, or at least 5,200 where the next call wall is. Now, when we put it on this metric, this is the weekly. It kind of brings in the idea that we didn't really get anywhere this week, but we needed to pause, right? We'll just kind of back up a little bit more. Remember that QRA we had at the end of October, the 1st of November, and we ran all the way into January. And we had QRA at the end of January, right into February. So right in here, we had QRA. Big run up, a little bit of pullback, a new run up, a little bit of pullback. We're ready for a new run up. And if you put it on a monthly, take a look at that. I know you're thinking, monthly, I'm a day trader. What do I care? Well, you should. Can't tell you how many great trades I've gotten as a day trader in futures because I looked at a monthly chart. The easiest thing to ask at this point on a monthly is, do you feel like that is bearish? By any stretch of the imagination, does that look bearish? Not me. Not me. I don't think so. Not even a little bit. Seems like they're unwinding the hedge. It seems that they were just protecting themselves through that Europe data, and now it's getting unwound. So we have not hit either edge of the ADR. We're expecting some volatility when we get econ later in the morning, but it's not a big enough threat for them to hedge, or they wouldn't be unwinding the one that they have. They would keep it. I mean, what's a couple more hours among friends, right? If they were worried about it, they already have it on. They would just leave it on. When we haven't hit either side, it opens us to the coin toss possibility. I don't know about you, but I don't like to trade a coin toss. So I'd rather have something concrete to focus on. Right now, the concrete focus is getting the gap closed from when we got the Europe data. So getting back to 5108, or I mean, if we get that close to cog line, call it 5111. Let's get back to that first. Then on the other side of that, we can get at the very least a VWAP reciprocation. Whatever we got to the bottom side of VWAP, measure it and put it on the upside. That'd be your upside target after we get that gap closed. That should get us pretty close to a breakout of yesterday's high or our own Globex high. And if we can get past that, we're way too close to the ADR to not hit it. So we'll use that as the next target beyond. All right. Now you could get fancy and, do some kind of trend line breakover, calculated move and whatever. Gap close, Globex high, 50% reciprocation from VWAP, previous week's high. Pass that into ADR. Easy enough. Now we could get bearish. We do have enough data today that could cause us to get bearish. We would look to get underneath that daily pivot point, back below the previous week's close, and then we'll start focusing on the volatility trigger, the lower ADR, the 3-week moving average, and the 10-day moving average. Piece by piece, we'll just work our way down level by level. It's worth capturing 50% of yesterday, marking that zone out, which it looks like that option level at 50.84 did a reasonably decent job, but I'd want something a little more accurate than that. Notice I'm only talking about measuring the RTH, the regular trading hours of yesterday. I wasn't discussing measuring the entire day. You could, but that will adjust your halfback level considerably, right? Because then we would be measuring all of this. That's a much wider zone. All things considered, if we chop about here for the rest of the week, the market's going to be happy with what we accomplished. I know it's not really what anybody wants to hear. It looks like a good day to trade. We're getting some decent moves. But right now we're stuck inside this zone. And we could just chop about, poking out of the top, falling back in, poking out of the bottom and rising back up, and just stay right there in that Globex zone into the close. So I wouldn't get my hopes up for something really good unless we can get above that 5111 cog line and get outside of yesterday's high. If we can do that, then we can challenge last week's high and we can get above that ADR half, 5126. And then we can talk about some big moves. For the downside, there's so much structure and so much support down there that it would have to be something really negative in the news to take us below yesterday's low. And I struggle to see what would be so damning or so bad that would get us to do that. Even just the RTH low would be hard from yesterday, getting through that. So, I would never say we can't fall down there, but the base case of breaking that low and getting below that low is very slim. Not without something really, really bad. 10-day, 30-minute volume profile, we are flirting with the point of control. As we lose more of these candles from the left, we're going to begin developing a classic P shape. It's the first time we've had any real classic pattern for a while. We don't have it yet. We still need to lose these candles, and when we do, we'll knock out a lot of this volume. Next week, if we don't fall lower than the low of yesterday, as we get through the week, we're going to lose a lot of this volume down here, and there just won't be anything left, so that in the later part of the week, we'll have a classic D shape. That's all assuming we just stay in this zone, which is it's a really big assumption. We just spent a whole week sideways. It's hard to believe that we're going to spend another week sideways, especially when we've got some pretty big events on the horizon too in the later part of the week and in the next following week. $50.50 seems like an easy number to keep track of. I'm pretty sure that's going to be the structure that we don't go back down below until we get at least closer to OpEx. And even then, I mean, if we break this high, that'll be our new support, right? And I don't mean just a candle wick above it and drop back down. No, I mean like getting up there, closing above it, holding it, building structure up here. We get above that and keep it, then all of this will be gone and we'll be dealing with an entirely different regime anyways. And we will again have the point of control a long ways underneath price. But right now, we're right there. It kind of makes sense that we're right there. Point of control is what? It's where the greatest amount of trades happened. So we tend to go back to where everybody was the happiest. We had a point of control at 50.95 that was hit yesterday, so we don't need it there anymore. We could mark yesterday's point of control and carry it forward into today. Just keep in mind, it's not a VPOC at this point. It's been hit twice. It was hit in the Globex before 8 o'clock last night, and then it was hit again when we had that dump out of Europe. So it's a point of control at this point. It's not a VPOC, virgin point of control. Now, I only keep track of the VPOC. I don't need the POC level. So I'm not going to carry it forward into today. But I've had people ask about this, and it's a good question to ask. Don't get me wrong. Always ask questions. If you study volume profile, the books will tell you, take yesterday's volume profile, the value area high and low, and the point of control, and plot them into today. And if you don't have enough pivot points, then you should absolutely do that. What we mark out every day is a pivot point that has not yet been hit by price. So if I was going to try to mark out yesterday's point of control, we can see it's been hit by price. It's no longer untouched. So it's not a VPOC. I don't need it. So I'll take it off. You can collect a lot of those VPOC levels, as we demonstrate here. I've still got a lot of them where price just has not hit them. This one, although it looks like price hit it, that's the day that it was built, right? So the next day after it was developed, we put it on. It's just carrying forward the point of control, the place where there was the greatest amount of volume on that day. Now, to add to this, some people only do the VPOC on special days. Say you trade equities. Some of the special days could be earnings, dividend, a big gap up day, a big reversal day, investors conference event, anything that is deemed noteworthy for whatever reason. You can put a VPOC line on that. And even if it isn't V, maybe it's been hit, but it's a point of control from an event. It's very much like an anchored VWAP at that point. You're keeping track of a particular point in time and the volume change from that time frame. For the ES, yeah, I don't know. I mean, I guess you could do the expiring contract or the new contract date. I've anchored some VWAPs from that date, and I didn't see any value out of it, but I was only doing it on one futures product. I didn't do it on gold, oil. I don't know, experiment, right? So we don't have a VPOC from yesterday. We're still declining back towards the 10-day, just a little beyond 0.5%, and we're on the decline. But the blue line has kind of leveled out. Looks like it wants to turn and go higher. The blue line is the average distance. We can look at these bars, and that can give us some hints about where we are right now. We're at 0.64%. And where we have recently been, like almost 1.5%. But what's the average? Well, that's where the blue line comes in. So it's just giving us kind of a snapshot of the average turning point right now. And when volatility is high, the average turning point is higher. So we kind of get a feel for, upside, downside moves. We're about at that average distance, just underneath it, kind of hovering there, have been all week. We're almost 3.25% away from the 10-week. So we've been farther away than this, but not very often, and it doesn't stick. So a lot of times we get above it, we just come right back in again. We could pop to the upside. The takeaway from this right now is that, sure, we're extended, but we're not, quote, overbought. We haven't moved too far, too fast, and it does not owe us a pullback, even from here. When we get into the new week, we're going to get some new information here, and that's going to help straighten everything up. Without even drawing the box, we can see next week has less volatility than the week that we're in. We don't even need to draw the box to see it. The 10-week is used by so many analysts. When I was reading a book on this, remember back, well, I don't know. Okay, let's not use the word remember. Back in the day, when the aspiring trader wanted to chart things, they had to do it by hand. They would use graph paper and they would chart on paper, and they would wait for their broker to send them charts in the mail, especially over the weekend. And they would calculate their moving averages. And the 10 is an easy moving average to calculate. So that's where it started a lot. Then you start getting into other moving average books, and it'll talk about the multiples. So the guy's name escapes me at the moment. He's the guy that really revolutionized the anchored VWAP. Oh, poor guy. Hope he forgives me. But that dude really highlighted the case for your moving averages need to calculate as a multiple of. Now, you and I in the modern world, if we want our 5-minute chart to show the daily 50-period moving average, I can just bring out an indicator, put it on my 5-minute chart, and I can see the daily 50-period moving average. But is it starting at the right point? Does the daily moving average begin its calculation on the right day, the right time? Wouldn't it be better to use an actual 5-minute indicator for my 5-minute chart that is the right multiple to show me that 50-period moving average from a daily, but on my 5? And so different moving averages are used because the higher multiple equals something else. A lot of reasons why the 10-week is chosen. Those are two for anybody who wants to dig deeper into it. Nowadays, the easiest answer is just to say, because it's what everybody else uses, right? Even though that's a poor answer. It's the easiest one. Look at every publication from fund managers, hedge funds, brokers, trading companies. Everybody mentions the 10, you know. Man, I feel bad for forgetting that guy's name. I need more coffee. Nine 45, 10, 1, and the Fed speakers. So one of the things you're going to want to watch for is a resumption of the animal behavior, right? The animal spirits that they talk about on Bloomberg. We want to see everything just get all bowled up. One thing that I like to use as a kind of a phrase, the market will get tired of waiting, right? We've been in a hurry up and wait mode all week, waiting on data, waiting on data. Brian Shannon. Yes, thank you. Brian Shannon. He's got a really good book on moving averages and the multiples of and why certain numbers are used. So the market will get cautious. It'll tiptoe and it'll wait on things, and we'll start to go into these holding patterns where we start to megaphone off of each side. But at some point, the market just gets tired of waiting. It gets tired of tiptoeing. It gets tired of being worried. And it just says, let's just flush it and start over. Well, that's a lot of times where we get some capitulation move to the downside, and then we rebound like a bungee cord and we break through the top and start running. We didn't really get a capitulation move down. Not really. Not the kind that really kind of flushes out liquidity. But we could still see the market say, screw it, let's go, because we've seen those options roll up. If we hadn't seen those, I'd say we probably just go into the close with a whimper. And believe me, we still could. I mean, at this point, I don't see anything that says we're going to break the high today and keep going up. But that can come in after econ, right? 10 o'clock. So from right now, because of the option behavior where they rolled everything up, the market could just say, screw it, let's go. But I got this sneaky suspicion if it doesn't, we're just going to chop about here. We're going to get some volatility because we do have econ. We're going to chop about, go into the close, and they're going to call it a good week. So what you're going to want to watch for, if it's going to be one of those blow-off days, you can go to advanced decline. I like Thinkorswim's advanced decline because you can actually dial it in and get some money. If Thinkorswim will work, come on, baby, you can do it. There it goes. I asked too much out of Thinkorswim sometimes, it seems. So you can choose your watch list. We'll just go in and pick something like, oh, I don't know, the NASDAQ 100. And these are detachable, so you can load as many of these as you want. You pick the NASDAQ 100 using the index watch, and what you'll get is advanced decline, which is fine. But you'll also get the capital. I like to watch that capital. If I have 90 names advancing and 10 names declining, but I have more money leaving the market than coming in the market, then there's a divergence there between the capital flow and the issues. So it can be kind of telling. What we want to look for today, if we're going to get some breakout continuation, is we want to see a lot of money flooding into the upside, and we want a disparaging amount of advancing issues. Not that 70-30 kind of stuff, really not even 80-20. I want nothing less than 85 or 90 advancing issues. That's a good start with the money flow right behind it, and not just in the NASDAQ. We need it in the NASDAQ and in the S&P. That'd be a good start. This everything rally gives the fangs a chance to breathe, which is great. But if we want a resumption in the indexes, then those Mag 7s need to get off the bench and to get in the game. And if we don't see that today, we're very likely not going to get that breakout today. So you can watch the NY Fang, kind of keep an eye on that. If we look at what's down this morning, bonds are down, and I tracked this ETF here, ETN, of a FANG index that is built for shorting the FANG, right? So it's an inverse FANG product. It's down this morning, but it's not down enough, right? The number that I use is 0.5%. So what we do have that's down 0.5% is regional banks, KRE. That's one that we watch all day long, and bonds. Those two, that's it. Nothing else is down more than 0.5%. And for what's up? What's up? China ADRs, the same FANG product, only for the upside. So this is a product that just looks at the upside only. You got FNGU, which is FNG up, FANG's up, and then FNGD, it's down. FNGD is FANG is down. Semiconductors are up, Bitcoin is up, gold is up, emerging markets, which is China again, more gold. There's the FANGs, the little homemade ETF that we use. That's pretty broad, but it's not broad enough. Want to see more tech in there. The fact that we have Bitcoin and semiconductors up is normal. There's a lot of semiconductors in Bitcoin proxies. So they're both representing Bitcoin. That's not enough by itself. If we go into semiconductors and we find something like NVIDIA being up a lot and all the other semis up that mimic NVIDIA, then we can say, all right, well, we got semis up for their own reason, not just because Bitcoin is up. But Bitcoin is up, semis are up. That's not good enough. It's a good start, but it's not good enough. And we have the FANGs. That's the one we need today to really get in the game. We want to see communications. We want to see consumer discretionary. We need those top three, right? When we talk about the 9 grid, these top three are the risk on sectors. We need these and their ancillary products. So for consumer discretionary and for tech, we also want to see things like communications in there, semiconductors. Tech is so generic and broad, right? We need to hone in and see all sorts of tech and consumer discretionary. We need these. And sure, to a point, we kind of need the XLF. We need those financials to not be down more than 0.75%. If they go flat and the others are doing good, we can really get one of those rip your face off rally days. But without it, I think the market would be happy just to go to the end of the week. And as long as we don't dump today, they'll be happy with how the week ended. You can see my crypto list here. I say mine, but it's not mine. It came from the Smalls exchange using their crypto Smalls product, which was built like an ETF. I opened that product up and I took all the names out of it. Now, recently I added all these new Bitcoin ETFs from, like Fidelity and ARK and all the new ones, right? I added those in there too. So those didn't come from the Smalls exchange. But when you see NVIDIA, TSM, PayPal, all those were already in here. And that's why I said semiconductors and Bitcoin, they're cousins, maybe kissing cousins. But we can see really that AMD or semiconductors are leading on their own. So it might not just be semis are up because Bitcoin's up. It might be the other way around. Kind of case in point. The Pro Shares Bitcoin is down 1.8. That's odd. All right, commodities got whacked. As part of an earnings situation. So DBA is being punished for it. It's because one of the biggest names in this ETF got hit. Probably expect a little bit of defense on that one. Bonds down, dollar down. Nat gas, well, nat gas not quite enough. So the China ADRs, approach these with caution. I mean, if it's day trading, then so what? It's just day trading, right? BABA, Baidu, JD, PDD, NEO, XPEV. But they've been punished and brutalized quite a bit. You can see this radical fall that we've had here. This could just be a little bit of a relief bounce. And a lot of times they don't offer very good day trades. So, I mean, if you see something in the China ADRs that look good and offer an opportunity, you could go for it. But I mean, this isn't really encouraging at this point. So they are up as a class or a group, but it don't tickle. One name that I like is EDU. This is an education company that got a short report a few years back. And in the short report, they pointed out, you know, parents not happy with the company, just a lot of mistakes that all they needed was a change in management, change in business. And they've really turned things around. So when China's doing good, I tend to focus on this. And I've got long-term trades here, but just keep your eye on it. This is no better than anything else if it's just going to be a day trade. In fact, the liquidity is not as great as some of the others. If you're trying to day trade it, you might struggle a little bit. So crude, semiconductors, precious metals, but not XLE. So we're getting crude, but XLE is diverse. It's got a lot of things in there. And we can see that it's up a little, it's just not up enough. And then SPY in the queues, right? Waiting on things, just not up enough. Healthcare got whacked pretty hard yesterday. So we could see a little bit of a relief bounce in that direction too. You see healthcare got really a smackdown, but we've been running really well on this curve. And if we're going to get a relief bounce, well, we could get all the way back up to, say, yesterday's high. We're already up this morning at 145.11 or 145.25, maybe split the difference. So we're up a little bit, but getting back to the close, like around 106, get another dollar out of that thing wouldn't be too bad. Again, healthcare is not exactly highly liquid, but the ETF's a little bit cheaper than, say, United Health. It's worth taking a look at. We're going to expect, though, staples, healthcare, utilities. If this is going to be a bullish day, that's not really the place you want to look. If it's going to be a bullish day, then you really want to focus on consumer discretionary names, technology names, maybe a little bit of finance, but they're down. So I wouldn't look at them too hard unless you think we're going to get a flip there. I say finance like XLF, but it wasn't XLF that was down this morning. It was KRE, and that's regional banks. You'd have to open that can of worms. And there's not a lot of great day trading names in KRE. In XLF, there is. Just Those are some good names to trade. That's what I got for you guys. Be careful, be safe. Watch the